Hey everybody, this will be just a quick video on the RSI and RSI divergence, just in case that is a concept that you're still unfamiliar with. So the RSI is a technical indicator, it's a momentum indicator, and to add it to your charts in TradingView, you go up here, you click on indicators, and you can search for either just RSI or the full name, the relative strength index. Just click that and it will appear at the bottom portion of your screen here. So in a nutshell, the RSI looks at gains and losses over a certain period of time. And typically that is 14 periods. Yes, so it defaults to 14 period length. And for now, we can just leave that. No need to change that value at all. To get the actual value that's plotted here on the line graph, it's a bit of a math equation that we don't have to worry about. It looks at gains and losses over that 14 period time frame, and I think it adds or divides by 100, or we don't need to memorize the equation. All we need to know is how to interpret the value. So that equation does its thing and it spits out a value for us here. Now, a couple ways to use the RSI. One of the most typical ways is to look at extremes. So when you plot the RSI, you'll notice it will by default plot three lines, one at 70, one at 50, and one at 30. And so a lot of traders like to use this to measure what are called overbought and oversold conditions. So when the value of the RSI exceeds this line at 70, we can say that that represents an overbought condition, a bit of an extreme. And typically, or what we expect to happen when the RSI does hit those extreme values, is price to drop. So one way you might want to trade, and again, not a recommendation to use only this, but one way the RSI is commonly used is to identify overbought conditions and then sell, and then the inverse could be the case as well. Identify the places where prices are below 30, which would indicate an oversold condition, and then possibly you could set a buy order. However, the way that I like to use it and the way that I found complements Elliott Wave very nicely is what's called RSI divergence. And the clue to how to use RSI divergence is, of course, in the name. So we have some RSI divergence here. And it's quite simple. We try to identify an area on the chart where prices are doing one thing, but the RSI is doing another. And what that tells us is price might be going one direction, but the momentum as measured by the RSI, the momentum of that market is decreasing. So even though prices might be making higher highs, the energy behind that move is fading. And we have that right here. So we can see the RSI made a peak here around 74, 75. And then a few hours later, the peak is now at 71, 72. And the exact values don't matter too much. I typically like to draw a line from the highs just to show visually that the slope of the line connecting these two highs is downward, is to the downside. And then during this same time frame, if we were to draw a line, so from wherever price was at this peak to wherever price was at this peak, which represents these two peaks here. So we can see price is increasing on the chart, whereas the RSI value is decreasing. And so again, when you have price doing one thing and the RSI showing a different picture, that's called RSI divergence. And that is a great complement to Elliott Wave, a great tool or a great piece of technical analysis to look for in addition to waves. And again, just to go over this chart real quickly, I think we have some kind of complex correction. And again, I really like how A and C are almost to the tick, one-to-one. I like the RSI divergence. And of course, this looks like a bit of a ending diagonal pattern. So if this does fit the ending diagonal rules, and if we do get a small 5-wave impulse to the downside, I think this would be an excellent trade we should consider. So again, please don't hesitate to ask me any questions or to clarify anything. And that's it. Yeah, thanks, guys.